1 year ago this week, the 30-year mortgage rate was sitting around 6 3/4. This last Friday, it closed out at 6.83%. That's not only higher than where we started, it is the highest mortgage rate of the past 12 months. A war, an inflation cycle, and a Federal Reserve that has not moved once. And buyers ended up worse off than where they began. Now, here's the part that doesn't add up for the housing market nationally. More homes went under contract this year than last year, and the national housing supply of homes for sale is on pace to drop below where it was in 2025. Nothing got cheaper, and buyers bought more homes anyways. So what do they know that the headlines don't? That's what we're breaking down in this week's San Diego Market Matters, and I'm Karl, your San Diego realtor. Quick housekeeping before we get rolling. If you haven't hit the like or subscribed yet, go ahead and knock that out now, or you can catch it on your way out at the end. Either way, I appreciate you being here. Now, let's dig into this data. Let's start with a number that drives a big portion of this conversation, the 10-year Treasury yield. In plain English, is the interest rate our government pays to borrow money for 10 years. It's treated as the safest place on the planet to park your money. So nearly every other loan in this country gets priced off of it, your mortgage included. Think of it like the tide out in the harbor. Every boat is sitting at a different height, but when the tide rolls in, every boat rises with it. Your mortgage rate is one of those boats. So here's the relationship, plain and simple. When the 10-year Treasury goes up, mortgage rates go up. When the 10-year Treasury goes down, mortgage rates go down. If you track one number to know where your payment is headed, track that one. The 10-year Treasury closed out July at about 4.63%. Earlier in July, it touched 4.71, and that's the highest we've seen all year long. Rewind to the end of February, and this number was under 4%. So we've climbed more than 0.5% since winter, and we did it in a stair-step pattern with every spike every few weeks. Two things that drove it up this month, it's the back and forth on the Iran peace talks that kept pushing money in and out of the bond market. And every time those negotiations wobbled, the 10-year moved. On top of that, the inflation numbers have not been cooperating. Here's the comparison that matters most. At this same point last year, the 10-year Treasury was closer to 4.38%. We're running higher than we were 12 months ago, and that one fact explains almost everything you're about to see next. Now let's look at what that tide did to your payment. The 30-year fixed mortgage rate closed out this last week at 6.83%. It climbed on Friday to get there. The highest reading of the last 12 months is 6.85%. So we did not drift towards the ceiling this month. We parked on it. Here's the whole year in one sentence. The lowest 30-year rate for the past 12 months was 5.99%, and it happened at the tail end of February. The highest is where we're sitting right now. Both extremes of the entire year landed inside a 5-month window, and we are on the wrong end of it right now. Now let's put this in dollars, because a percentage means nothing until it's money. On a $700,000 loan, the difference between 5.99 in February and where we closed out this last week, it's about $385 more every single month. On an $800,000 loan, it's closer to $440 a month. Here in San Diego, where our median price runs well above the national average, most of my buyers are borrowing in exactly that range. That is not a rounding error. That's a freaking car payment, and it showed up in 5 months. And here's a piece of this that almost nobody is talking about, and it got more valuable this week. The 15-year fix is sitting around 6.25. FHA and VA are both around 6.35%. And Jumbo is the outlier at 6.9%. Now watch what happened on Friday. The conventional 30-year moved up 6 times more than FHA did. The government-backed products barely budged while conventional took the hit. That leaves FHA and VA sitting roughly 0.5% below the conventional 30-year right now. And on a $700,000 loan, that gap is worth somewhere between $200 and $250 a month. If you are a first-time buyer or a veteran and nobody has walked you through those options, you are leaving that on the table. Now here's something most people never think about when they look at mortgage rates, and this month it's the most important story in the data. Let me explain it with something you have lived through. Crude oil prices dropped, you see it on the news, and then you drive past your gas station and that sign has not moved a penny. The station's cost went down. Your price at the pump takes its sweet time catching up. Whatever sits between those two numbers is the station's margin. Mortgage rates work the exact same way. The 10-year Treasury is what it costs the lender. Your mortgage rate is the price on the sign. The gap between those two is the lender's margin. And in this business, we call that gap the spread. Right now, that markup is sitting around 1.96%. At the same point last year, it was closer to 2.35%. Back in 2024, it was slightly above 2.5%. The historical norm is somewhere around 1.7%, so we are closer to the normal than we have been in years. Lenders have narrowed their cut 3 years running now. And this is why I want you to pay attention. That improvement was worth something. Compared to last July, the tighter markup alone saved you roughly $180 a month on a $700,000 loan. That's real relief, and it was handed to you by the mortgage industry. Feel free to tell them you're welcome. But you never saw a dollar of it. The 10-year Treasury climbed to its highest level of the year at the same time, and it swallowed the entire benefit before it ever reached your monthly payment. So when you hear someone say, lenders are gouging buyers, the data says otherwise this month and kind of over the last 3 years. The lenders are giving it back. The bond market is taking it. Now here's something that tells us whether buyers are responding to all of this, the Mortgage Purchase Application Index. This tracks how many people are filling out an application to buy a home, not to refinance, but to specifically buy. More people are applying to buy right now than at this same point last year. That's a real signal, and it has held all year. But the trend inside July tells the other half of the story. Applications peaked in early June and have drifted downwards every few weeks since. That is the rate showing up with a delay. Applications almost never react to rates the same week. Buyers see the number, run their payment, sit down with their agent, and pull back 2 or 3 weeks later. That is what we are watching right now in slow motion. Demand is still above last year. The direction inside the month is softer. Both of those things are true at once. Another reason buyers keep showing up is the job market. So let's define this one. Jobless claims count how many people filed for unemployment benefits in a given week. The most recent report came in at 197,000. That is near the lowest reading of the past 12 months. The number itself is fine, but the pattern underneath it is the interesting part. Look at the 4 biggest spikes over the last year. Early September was around 264,000. Late November came in at 236,000. Late January hit at 231,000. Mid-June came around 228,000. Every single spike is smaller than the one before it. Then look at the floor. The low points came in around 192,000, then 189,000, then 187,000. In the most recent report, the bottom is grinding lower too. Slower, but lower. So the highs are falling, the lows are falling. And yes, if you have been following the jobs data, you know it's all over the freaking place and comes with a mountain of revision. So take every single week with a grain of salt to a degree. The shape of this year is what matters most. And here's what that shape means. The spikes are layoff events, and each round of layoffs is smaller than the last. Companies are not cutting the way they were a year ago. That is a labor market quietly tightening, not one cracking. Employed people buy homes, nervous people wait, and right now people feel employed. Now let me be fair about the other side of this, because that number only counts people losing a job. It says nothing about how hard it is to land one, and if you have been out there applying, you already know those are 2 completely different markets. Sending in a resume and finding out that you're number 150 in the stack is becoming the norm, at least from what I'm hearing here in San Diego. Holding onto a job right now is a lot easier than finding a new one. There's a second consequence, and it's one nobody wants to hear. The labor market this steady hands the Federal Reserve every reason to sit still. They do not cut rates into strength. So if your plan is to wait on the sidelines for the Fed to rescue your payment, this jobs data says you will be waiting for a while. Now let's look at the national new listing data. New single family listings came in at around 72,000 this week. The peak for the year was roughly 85,000 back in April or early May, and we have been working our way down from there on the normal seasonal slide. And here's the headline on this one. The 2026 line is sitting almost directly on top of the 2025 line, and it's been all year long. Sellers are coming to the market at essentially the same pace they did 12 months ago. not a flood, and at the same time, not a drought. That matters more than it sounds, and you'll see why in about 2 minutes. Supply is being replaced at last year's pace. Hold that thought, because the demand side did not stay at last year's pace. With those listings hitting the market, let's talk about what sellers are having to do to get their deals done. Right now, about 40.7% of homes on the national market have had a price reduction. Call it 2 out of 5. Back in February, that number was near 32%, so it has climbed steadily every month of the spring and summer. For the context, 2025 was running a touch higher at the same point, closer to 42%, and 2024 was lower, closer to 39%. So we're sitting between those last 2 years, and the trend is up. Here's how I want you to think about this if you're a seller. This market is the Price is Right show. Buyers are the contestants. Your home is the item on stage, and the rules not changed since 1972. Closest bid without going over. You come in over that number and the buzzer sounds. Doesn't matter how close you were, doesn't matter how nice your kitchen is, you sit there and watch the next home come on down and take your buyer. That's what 2 and 5 means. 2 out of every seller's guessed high, heard the buzzer, and had to come back down on price to stay in the game. Price it right and it moves, overprice it and it sits, simple as that. And here in San Diego, where you're working with much bigger numbers than the national average, guessing high does not only cost you time on market, it costs you the buyer who was ready week 1 and moved on by week 4. Moving on, let's look at what those buyers are doing, because this is where the story gets good. There are approximately 397,000 homes under contract nationally right now. That is above where 2025 was at this same point, and above where 2024 was as well. Yes, we are down from the May peak of around 437,000, and that's completely normal. Every year follows this same shape, up through the spring, down through the summer. We are riding the identical curve, but we're riding at a higher altitude than the last 2 years before us. Now put that next to new listing data. Supply is coming in flat compared to last year. Demand is closing more contracts than last year. More are going out than coming in the middle of a war at the highest mortgage rate of the last 12 months. People are still buying homes. Next on the list, national inventory, and this is where it all comes together. There are approximately 870,000 single-family homes for sale nationally. Compared to 2024, we're up by roughly 200,000. Compared to 23 and 22, we are up dramatically. Buyers have far more to choose from than they did 3 years ago, and that's a genuine improvement. But look at 2025. Back in January, we were running about 70,000 homes ahead of where 2025 was. Today, we are dead even with it and arguably a hair below. That entire cushion closed over 7 months. Inventory has already turned the corner and started its seasonal decline. And at this rate, 2026 crosses below 2025 in the upcoming weeks. Here is the mechanism, and it's the whole episode in one idea. Sellers are listing at last year's pace. Buyers are going under contract faster than last year's pace. When the water coming in stays flat and the water going out speeds up, the tub drains. We are burning through inventory. That is not a market building up a cushion of unsold homes. That is a market working through what it has. Bottom line, the national picture in July is a market that had every reason to stall and did the opposite. Rates hit a 12-month high, the 10-year Treasury climbed to its highest point of the year, inflation has not cooperated, and the Fed has not moved. And buyers went out and put more homes under contract than they did in either of the last 2 years, while supply came in flat. None of this makes sense. They're not doing it for free, and I want to be honest about that. Purchase applications have softened since early June. 2 out of 5 sellers had to cut their price to get it done. The buyer won that negotiation, and the seller paid for it. The price cut is not a sign of a broken market. It's the mechanism that is clearing it. So who's positioned well right now? The buyer who's ready to transact this quarter. You are shopping in a market where 2 out of 5 sellers have already shown you they will negotiate, and where inventory is at its highest point it will reach this year before the seasonal decline takes it even lower. That combination does not last, and the seller who prices to the market on day one is still getting deals done. Still seeing multiple offers in the right price band, and is not sitting through 60 days of silence waiting to lower the price anyway. Here's the question I'm gonna leave with you. Everybody sitting on the sidelines is waiting for something to get better. But rates are at a 12-month high, the labor market is too strong for the Fed to cut, and inventory is on pace to fall below last year. If supply keeps shrinking while you wait, does waiting help you at all, or does it cost you quietly? A lot of smart people are convinced patience wins here, but a lot of this math does not agree. Let's hear where you land on this in the comments below. Next week, I'm going to take all of this national data and see how it stacks up against what we're experiencing here locally in San Diego. Is our inventory burning down the same way? Are San Diego sellers cutting prices at the same rate? Or is this market doing something completely different than the rest of the country? Come back next week and find out then. And that's a wrap for this week's San Diego Market Matters. If you haven't liked this video yet or subscribed, here's your chance to do so now. Thoughts, questions, or concerns, don't hesitate to reach out. As always, I'm Karl, your San Diego realtor. I'll see you next video.